Hello options traders, welcome back. I hope everybody had a fabulous weekend. So a happy Monday to everybody. And I wanted to talk a little bit about the importance of being able to break down a strategy. And I thought I would do that by talking about a specific example with the Straddle-Straddle Swap. Now there are a lot of different strategies that have the same recipe. There's a Straddle-Straddle Swap. There's a lot of them that have similar sounding names. But regardless of how complex they might sound, they're actually not so bad if you understand how to break down a strategy. So let's do that. What is a Straddle-Straddle Swap? Well, before you can understand a Straddle-Straddle Swap, it would probably help to understand a straddle. So let's do a quick review of that strategy. A straddle is where you will buy a call and a put with the same strike and the same expiration. So for instance, you might buy the January $100 call and then buy the January $100 put. So because you have to pay money for each of these, you're essentially paying double for the call and the put. Only one can expire in the money. And let's just say that we have a net debit of 10. That's just the cost of the call and the put combined. So if we did that, this would be the resulting risk graph. So as you probably know, we get our bend right here at the strike. Call and the put both share the same strike, so we only have one bend in the graph, but we have unlimited potential if the stock price rises, and we have unlimited potential if it falls. And of course, the worst case scenario is for the stock to close at exactly the strike, where both options expire worthless, in which case we would just lose the amount that we paid, or 10 bucks. So once you understand the basics of a straddle, what is a Straddle-Straddle Swap? Well, it's very similar. You're just going to do a purchase of a straddle and a simultaneous sale of a straddle. Now, of course, it doesn't really have to be simultaneous. Maybe you buy the straddle first and then at a later date sell a straddle. Same idea. But here's the essence of the strategy. You're going to buy a long dated straddle and you will sell a shorter dated straddle. So that's why it's a Straddle-Straddle Swap. So for instance, let's say that you buy the March 100 straddle and maybe it costs 10 bucks, and then you sell the January $100 straddle maybe for a credit of 6. So if you put these on at the same time, it would be a net debit of 4. That's just the net between those two. You're spending 10 and collecting 6. So if you put these on at the same time, these are the independent risk graphs. Now, of course, it looks really complicated. We have two different strategies going on at the same time. But this is where it can help to break strategies down. Is there a way to simplify this? Can we find out exactly what we're doing? Well, there is a way, and I've shown these little techniques before in previous videos. This is just a simplified layout of your broker's platform. We have different expirations, we have calls and puts, plus and minus for long and short. So let's start with the long $100 straddle. We would buy the 100 call, so we're buying one contract. I'm going to put it under the plus column of the call to show that it's long. We're also going to buy a $100 put, so we put a 1 there. Now we're going to sell the January straddle. Same idea. We're going to put a 1 under the minus column for the calls, same thing for the puts. So this is a short straddle for January. So again, the question is, what have we done here? Well, this is where we can use some techniques to break strategies down. And I've talked about these before in different videos. We've talked about a jelly roll in different videos using conversions, reversals, ways that we can simplify strategies. Well, whenever you're dealing with different expirations like this, the jelly roll is a very handy tool. So even though you might not ever use a jelly roll by itself, it can still be a helpful tool for understanding strategies you are trying to use. So recall that a jelly roll is a synthetic long in 1 month and a synthetic short in another at the same strike. So let's put one on. Let's do a synthetic short for January. I'm going to sell one call here at the 100 strike, and I'm going to buy a 100 put over here at the same strike. And then we're going to couple that with a synthetic long down here in March. We're going to buy the 100 call, and we're going to sell the 100 put. So I've also mentioned this before as a kind of an easy visual way to understand a synthetic short and long. If you have a short distance between these two ones, that distance right there is relatively short, that's a synthetic short. This distance down here in red is relatively long, so that's a synthetic long. Now, for those of you who understand synthetics would certainly know that a long call and a short put is a synthetic long. And then just the opposite here, we have a long put and a short call would be a synthetic short position. But regardless, the 4 positions here in red represent a jelly roll. And look what it's done for us. Up here in the puts, we have a plus and a minus. They cancel. Down below for March, same thing, plus and minus. They also cancel. And what are we left with? Well, up in January, we have 2 short $100 calls, and down in March, we have 2 long $100 calls. So what is a Straddle-Straddle swap? Well, it's just a calendar spread done twice. So this is another term for a double calendar, which many of you might be familiar with. But part of my point is to show that you might think, hey, this sounds really complicated, a Straddle-Straddle swap. And when you learn to break it down, you say, oh yeah, it's just a double calendar. So if we take a look at the risk graph here, this is what it looks like, and that is in fact our calendar spread, or a double calendar. It's going to look about the same. So the main point I wanted you to get from this video is that if you really want to advance your trading and your skills and the opportunities that you see, you need to be able to break down positions. And this is a really good example of how you can get a lot of insights into the trades that you're placing. Or maybe you put a trade on, you're breaking it apart. Effectively, what have you done? And this is what will allow you to have different opportunities, see different risks, and therefore have more success. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.